Well, we had some good news last week. The debt ceiling passed. Unfortunately, the bad news about that is student loan payments are going to start to resume. So that is going to freak out the markets eventually. So that's going to be about what our video is about today. So let me give you my thoughts on how this is going to play out. So we have a ton of debt out there right now. Let's see how much student loan debt is out there right now. Well, the average person currently has a monthly payment. If you have an associate's degree, about $200. If you have a bachelor's degree, about $300. If you have all the way down to here to a medical doctorate degree, you might be looking at $2,500 to $3,000 a month in expenses. So you didn't have these for the past 3 years. So what's happened during that time? Well, let's go over to a chart that we have here, and this is consumers' disposable income. I've brought up this chart many times before, but I want to explain something to you guys. Let's go back and let's look at the maximum chart here. This is from the Federal Reserve of St. Louis. Okay, so it's a valid data. If you go through here, this is how much disposable income people have throughout the years. So you go down through here, starting in 1960, people wanted a better life for them and their families, so they saved money and they worked hard and saved money and did it all the way up to here. And then, whoa, what happened? Let's dissect this area. So we go through here, it continued through, and then what happened right here? What caused this? Well, March of 2020. What happened in March of 2020? Oh, COVID. So what happened at that point? Well, people's disposable income spiked to the highest level at that point. Then not too long after that, it spiked even higher to the highest levels ever in history. Then it came right back, and now we're teetering just a little bit above where we were previously. Well, what happened? Well, let's go through this. Let me walk you through the scenario and what created such high inflation. Well, first off, right through here, people were pumped with a lot of money from the federal government, and we can see that through here. If you don't believe me, I can guarantee you probably got a check, and kudos to you. But that also increased the money supply, which you're seeing down through here, right in this area. So when you have too much money in circulation, that's proven from there and right here, what happens to goods and services? Well, you have a ton more money chasing the same finite amount of units or products. But remember at that time too, these products were having very much difficulty being shipped from where they were manufactured. We had a shipping supply issue. So we had even less supply. And we had all this money. So all this money is chasing fewer goods. What happens in that situation? Prices rise and rise and rise and rise and rise. Okay, that is inflation. Okay, that's another thing that happened to housing. But the problem is with this scenario is now the money's getting sucked out of the system. People are going back to work. People are starting to buy again. But in housing, there's a lot of housing sitting on the sideline. You have people with 2-3% interest rates that aren't putting that supply in the market. So now you have less supply with the same amount of demand, or a little bit less demand. That's why you're not going to see a housing crash, but I'm at least giving you the ideas or the format behind why things got so expensive, okay? We had a ton of money out there, and we didn't have as many goods at that time, and that is proven right through all these charts that I have. So what's really conflicting the markets right now is you have people like this. He's the former Fed chairman, Roger Ferguson. He just came out today and said there's going to be no rate pauses, and we're going to have higher rates. But then you're thinking, well, he's saying this, he's the former Fed, so he should know what he's talking about. Well, let's go over to the Chicago Mercantile Exchange. Well, the Chicago Mercantile Exchange, what they do is they trade this stuff. It's basically legalized gambling kind of sort of, but it's a Chicago Mercantile Exchange. They have futures markets that does this. What's the likelihood that the Federal Reserve will change the federal targets fund rate at the next meeting? Well, the current rate right now is 5 and 5 1/4. So let's go down through here and see what the probability of it staying where it is, or maybe reducing or going up. So Rogers said it's going to go, they're not going to pause. Well, the markets right now are telling us something otherwise. So this is the meeting probability. So the meeting coming up is June 14th, which you can see right in here. And the federal funds rate right now is 5 to 5 1/4, right through this range here. You see there's a 75% probability they're not going to do anything. there's a 50% or more than a 50% probability they're going to do something in July, raising rates, and that's through here. But my concern right now is this. You have Federal Chair Rogers, or former Federal Chair Rogers, coming out saying, no, they're not going to do anything. But then you have the markets telling us something else. That's why there's confusion in the markets right now, folks. So with that being said, let's get over some of the data that you want to see. So with all this information out there, what's going on with mortgage rates? So what you're seeing right now is the 10-year Treasury and the mortgage-backed security bonds. So please don't pay attention to the 10-year Treasury. And if somebody says, what's going on with mortgage rates? If somebody says the 10-year Treasury, say, no, you got to follow the mortgage-backed securities market. So that being said, mortgage-backed security market right now, the price of this bond is down 19 ticks. What does that mean? All you need to know is if this number is down, rates are going up. Okay. We love when this number goes up. Look at yesterday's numbers. Look at this. It was up, 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 and away. You see that right through there. You can't see the green, but we started the day here and we ended the day there. So that's up. Okay. How's that affect rates? Here's mortgage rates. So these are the top 6 programs that people use when they're buying or refinancing a house. These are not my rates. These are no individual bank's rates. These are the national average for a borrower that has this scenario. Now pay attention to this scenario because this might be you or might not be you, okay? The scenario is this. You have a borrower looking to buy their first house. It's going to be their primary home and it's going to be a single family home. They have a 740 credit score and they're putting 20% down. So basically the perfect scenario. What would the rate be? Well, there they are right on the screen. So how do you find out what kind of rate you would qualify for, or can you even qualify to buy a house in this market? Well, the best way to find out is schedule a consultation with us or apply online or give us a call. We'd love to help. My name is Dan Frio. I do the rate update every day to make sure you're an informed consumer. If you're looking to buy a house this year, or maybe you're looking to refinance, maybe you need a reverse mortgage, we'd love to help you. I have over 30 years of experience in this business, guys. So I've seen these trends before and I can help you navigate this market. So a few different ways to get a hold of us. One, give us a call. 844-775-5626. Or if you're ready and you're like, okay, I just need my rent, my lease is up in June or July. I need to get out of this place and find a house. Well, just click the apply now button. It's right over here. Or if you're like, I'm really concerned, but I have a lot of questions that I need answered. Well, that's easy too. We have a consultation button down below where you'll have a one-on-one consultation with me or one of my mortgage advisors to help you guys walk through and navigate this home buying process. So thank you so much, guys, for watching. God bless. Have a fantastic weekend, and I'll see you next week. Bye-bye.